Two numbers made Tuesday look like two different markets. The SPX lost 0.69% and closed at 7,692. Underneath it, the Nasdaq fell 1.7%, while the chip and artificial intelligence group lost about 5%. That gap is the story. The decline came from inside the market's leadership, while the broad index absorbed most of the shock. The cash index finished down 53 points at 7,692, its second lower close in a row. Futures settled at 7,714. VIX rose about 4% to 15.85. Yet volatility eased to 92.87. And fixed strike index volatility finished nearly unchanged. Price fell, but the broader volatility surface did not reprice as if the whole market were under stress. The separation opened at 2:39 Eastern. A senior figure at a major artificial intelligence laboratory said the firm had temporarily slowed the scaling of frontier model training. Leadership names weakened after that headline, not before it. Chips lost about 5%, but only about one-third of that move reached the broad index. That is the arithmetic of a concentrated leadership shock, not a market-wide exit. The positioning data made that distinction clearer. Index hedging flow finished net positive by about $3 billion, dominated by same-day put selling. On the single stock side, hedging finished near negative $2.5 billion, including roughly $1.5 billion of put buying. In plain language, protection demand concentrated in the companies, while index participants sold downside protection. The same afternoon produced opposite flow signs, and the fear had a specific address. There was another reason the decline stayed orderly. A 14,000 contract same-day put position created a positive hedging cushion during the session. That support disappeared when the options expired at the close. Tuesday's calm was partly mechanical. Wednesday begins without that exact cushion, unless comparable supply returns. So price may respond more quickly around the key dealer line. The key divider is 7,700 in the cash index. Price closed 8 points below it, on the side where hedging can reinforce movement. A reclaim targets the 7,711 pivot, then the 7,742 to 7,755 resistance zone. Below the close, the first demand band is 7,666 to 7,677. The deeper support shelf is 7,635. Acceptance beneath that area would mark the first meaningful technical damage. The volatility surface is equally important. 1 month implied volatility finished near 12%, below realized movement near 13.5%. That makes options inexpensive relative to what price has actually delivered. But downside protection ranked near the 87th percentile of its year. Total movement is inexpensive, while insurance below the market is costly. Traders are not paying broadly for volatility. They are paying specifically for the exit. Our desk recorded 1 scratch, 1 minor loss, and 1 loss on a full contract position. Nothing remained open overnight. The first future support near 7,720 held each test, while the clean downside break never developed. It was a two-sided session, but the scorecard is the scorecard. 2 losses, 1 scratch, and the book closed flat. For Wednesday, everything begins at 7,700. Reclaim it and hold, and the map turns constructive towards 7,711. Then 7,742 to 7,755. Fail to reclaim it, and an early test of the 7,666 to 7,677 demand band becomes likely. The afternoon carries a concentrated risk window. A 20-year Treasury auction at 1 o'clock, followed by Federal Reserve minutes at 2. Wednesday also brings volatility index expiration, while Friday carries monthly options expiration. The open question is whether Tuesday was a one-session scare in the leadership or the first crack in the advance. Flow argues for a contained event. Price, closing below 7,700, has not confirmed that answer. We track every level publicly at AlgoIndex.com/tools/gamma level accuracy. I will be back after Wednesday's close to show which branch the market chose.